Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for March 8th, 2021. Please see our disclaimer for important information. Well, suffice it to say, I think the main issue of conversation in this week's commentary is interest rates. And interest rates have moved much, much higher. We'll talk a lot about interest rates and maybe the potential issues with regard to the equity market. Although I really do feel like we're in a good spot, even though it may feel weird having such a what seems like a fairly rapid move in interest rates. But we'll kind of talk about that. But I do think that the markets are healthy. We're seeing a bit of a rotation into some of the value and more cyclical areas that I had anticipated, over the course of several months. The fact that we're seeing some inflation on the margin, particularly in the producer channel, we've got it actually building a little bit in services as well. We haven't really seen a labor price increase in terms of employment cost index indicators and things like that, but because we still have a lot of labor slack, and I think that's the one thing that is really over the head of the Fed right now. Of course, they have a dual mandate for full employment and price stability, and right now I think the full employment is something that they're aspiring to, and actually in particular, which kind of is some commentary on on the modern day environment. They're also concerned with that full employment measure as it relates across socioeconomic boundaries too. So I think that's the one thing we can all point out to say, the Fed's going to be on hold for quite some time. Of course, the market had a little bit of, the equity markets had a little bit of a gyration last week because of this feeling that the Fed wasn't going to step in and try to control interest rates. And we've been used to low interest rates for so long that it was a little bit of a shock to the system when, interest rates that have, frankly, since last July, the 10-year Treasury has moved up a full percentage point, ending last week at 1.57%. And that's an astounding move. And it's actually up almost 0.7% just in, essentially 2.5 months, or slightly over 2 months, rather. And so a lot of people thought that the Fed was going to jump in and say that we're going to try to, that they're going to try to manage interest rates back down. And it just didn't happen. And so markets were a little bit jumpy on that. But we'll talk about interest rates quite a bit. And we've got several different pieces that sets of notes that I took over the weekend. But in any case, let's go over the market data. So last week, the S&P 500, was up 0.8%. The Dow Jones was up 1.8%. NASDAQ was actually down 2%. A lot of the tech stocks kind of sold off. The Russell 2000 was off about 0.3%. So, in fact, NASDAQ is down over 8% in just the last 3 weeks. And so we've seen a little bit of rotation out of tech stocks, like I said, into some of these more cyclical areas. But, over a longer stretch, we still have strong outperformance by some of the tech stocks. In 2020, they were up 44% almost. And so looking at year to date, most of the major domestic indices are up. S&P year to date is up about 2.3%. Dow Jones up slightly less than 3%. NASDAQ is positive slightly. And then the Russell 2000 small caps are up about 11%. Frankly, would love to buy more small caps. I think they're well positioned in this global synchronized recovery, but obviously the market has anticipated that and don't feel like there's perhaps as much value there as there has been. But if you look at Europe and you look abroad, we see some different kinds of signals. So for the month, Europe, the MSCI Europe and the MSCI EFA index are down slightly. The Europe index is down ever so slightly. I'll just call it break even year to date. And the EFA is just slightly above break even. Emerging markets, which had actually a pretty phenomenal year last year, they were up about 15, 16%. up about 3.7% year to date. Now, if you go to the bond market, obviously with the rise in interest rates, we've had a little bit of an offset here. So the Barclays aggregate bond index is down about 3%. It's down about 0.8% month to date. And if you look at high yield, it's actually positive. So, with interest rates moving higher, we've only seen spreads kind of narrow in high yield. In fact, year to date, spreads on high yield have actually tightened by almost 0.3%, which is indicative of a very positive credit environment, high degree of complacency that there's not going to be a credit event on the near-term horizon, and something that you typically see in a upward sloping and improving economy. High yield, as I mentioned, it was down a little bit last week, but strong for the year. Leveraged loans are up as well for the year. You talk about the crude market. What was really interesting is last week, the OPEC Plus meeting ended, frankly, with a decision to keep production cuts in place, perhaps with a small exception for Russia. And so what that did to crude prices is it continues to send them higher. Crude ended last week at $66 a barrel, slightly above that. So for the month, it's up about 7.5%. Year to date, it's up 36%. Crude prices up 36% when they were down 20% last year. So we've seen basically a full reversal in crude prices, throughout the pandemic here. Natural gas up year to date, positive by about 6.4%. And with interest rates moving higher as a competitive asset to gold, and also interest rates moving higher, maybe reversing some of the decline in the dollar, at least for the time being. We've seen gold prices come off. Gold is actually down about almost 10.4% for the year when it was up 24% last year. So, and then we talked about spreads. We talked about the 10-year rate. What's interesting is, let's see, if we kind of going back to July, I mentioned the 10-year Treasury rate is up about 1 full percentage point. And then if you look at 5-year break-even rates, which is essentially a proxy for inflation, that's now up about 2 to 2.4%. And these are break-even yields. These are essentially, this is the market's assessment of where they believe inflation is going to be in 5 years, is 2.4%. And that's up a full percentage point since July, the end of July. And but what's really interesting, again, with the Fed kind of stomping down its foot on the short end of the yield curve, saying we're not going to raise short-term interest rates, that clearly we have not seen a move in those short-term rates and a steepening of the yield curve as a result. So on brief economic comments, payrolls were up 379,000 last month, and that was a lot stronger than was expected, which is really surprising because we had obviously a huge weather issue last month, and it caused a lot of dislocation in things like construction, manufacturing, so on and so forth. Jobless ticked down 0.1% to 6.2, and then the what we call the U6, or the underemployment rate, was roughly unchanged, about 11%, slightly above that. So in sentiment indicators, we have the ISM, or Institute for Supply Management, Manufacturing Index. That continues to do well. It was over 60 last month, and that's probably one of the more optimistic readings that we've seen in 10 years. The services sector is still positive. We see a little bit of noise in that. It was a little bit off last month, but again, very positive. And just for perspective's sake, manufacturing doesn't have nearly as much influence on the economy as does the service sector. So just kind of keep that in mind. But both readings are positive and very much conducive of economic expansion. So, talked about the rates situation. Market clearly doesn't expect Fed to raise rates within the next 2 years. I think, we're sitting at essentially 1.5, 1.6 on the 10-year. I've got a gumption that if the 10-year yield popped up over 2% in fairly short order, that what you actually could see from the Fed is maybe a little intervention. They're not talking about it now because they don't want to, they don't want to influence the market, even though they are by their inaction, as I should say. But something they've done before is what we'll call this twist. And so instead of buying certain instruments out in the open market and providing liquidity in the market by buying certain maturities, they can twist and they can buy other maturities. And so what that does is it influences rates in a different part of the interest rate curve. And so right now, what we're focused on is 10-year Treasury rates moving higher, and of course that's moving all of the kind of the longer dated interest rates higher. Whether it be corporate, obviously it's not influencing prime rates, but it will influence mortgage rates, and it has, frankly, already. And so with the Fed kind of twisting and maybe more of its asset purchases being more on the short end, you don't necessarily have as much influence, or they could frankly move longer and maybe bid up Treasury prices by being an active buyer in longer dated maturities, which would drive those yields down. But those are tools in the toolkit that I would expect to see the Fed begin to deploy. Just reading between the lines on what Chairman Jay Powell had to say last week. But the market, just by surveys, thinks the Fed's going to raise rates 3 times in the next 5 years, but really none in the next 2. And we're expecting higher inflation. We know that in the next 5 years. Now we told you about the 5-year break-even inflation rate, and that's considerably higher than it was, and it's actually higher than the 10-year break-even rate, which is pretty interesting. It's 10-year. The market is pricing inflation in the next 10 years at 2.2%. The market over the next 5 years is pricing it at 2.4, which is really interesting. So anyway, I need to continue to watch this. Right now, we're kind of getting a little bit of this good news is bad news thing. And good news is kind of indicative of perhaps higher inflation down the road, kind of expanding on that inflation thread. And so, the market's not digesting that as well. And I think it's an adjustment period that it's going through right now. I've said this in Charts of the Week, and I said this in Market Minutes in prior webcasts, but I honestly believe that rates are moving higher for all the right reasons. And we're getting into a more normalized environment. And it's moving higher because we are getting a little bit of inflation push. But having inflation is not necessarily a bad thing. Again, I'll reiterate what I've always said is as long as it's not outsized and unexpected. If it's something the market can filter in a relatively digestible way, then I think things are in good shape. And I think that's the environment that we have now. In fact, and as it relates back to equities, there's a lot of concern. I think during this adjustment period, I do feel like maybe there's the possibility of equities being a little volatile. And that's not necessarily a bad thing. Perhaps some consolidation would be very healthy in this environment. But the data is extremely clear that going back over, probably 40 to 50 years of data on rising interest rates, in all but a minority of cases, the equity market could continue to move higher. So just to reiterate, in periods of rising rates, the equity market tends to go higher because it tends to be associated with expansion and growth in the economy and the expectation of profits increasing for constituent firms within the S&P 500 index and other indices. But so that is what's going on there. Again, the Fed probably could have calmed the market a little bit last week, but they didn't really kind of come out and say that they felt like rates should necessarily be lower at this point. Yeah, as it relates to certain stock sectors, it's worth mentioning here that, this rising rate environment and the stimulus, led recovery probably will continue to benefit value stocks. And as I said, small caps will continue to have a bid underneath them. So would expect those areas to continue to move higher. But let's see. Moving over there, so I mentioned volatility. NASDAQ has certainly seen a little bit of that now. Markets are really pricing in this rotation trade into these cyclical stocks. We have this reopening from coronavirus, and so certain growth stocks are still very much have considerable value right now, but I think we're definitely seeing a bit of a rotation now because of the environment that is now materialized. But let's see. I would say I think we've talked enough about the Fed's action in the interest rate environment. If this move was really dysfunctional, I think the Fed would step in, but I would agree that the move that we've seen in interest rates has been really kind of orderly, and it's been kind of systematically higher. And so that's one reason that they're not stepping in. The other thing is that like I said, they're focused on the labor side of their dual mandate right now, and they're not so worried about inflation. But we are going to have to monitor inflation because we've got several things going on, right? We've got the governor's orders in Mississippi and here in Texas about ending the mask mandate and opening businesses 100%. And this will be a laboratory of sorts over the next 30 days to see, does it impact the health picture? And if it doesn't, then you're going to see a fairly rapid pace on the part of many other states to open their economies full bore as well. And obviously that's going to increase activity, probably increase expectations for second quarter economic growth, and you've got that. And then the other thing, of course, is the $1.9 trillion stimulus package, which is now back, as of this recording, back in the House after the Senate made some amendments to that. So I think it's very clear at this point that that is going to pass, and when that reconciled bill is ready for the president's signature, that will get done. I frankly don't think that we need all of that stimulus. There's parts of it that are clearly, I think, in hindsight, not as important now as they certainly were several months ago, namely the aid to states. A lot of states are doing pretty well now in terms of tax collection, and there's some other things that I think are perhaps a little bit gratuitous in their amounts, but in any case, that's coming, so that's going to add more fuel to the fire here, and so I do think the economy is going to be strong. Now, having all of this liquidity chasing fewer goods could inspire this inflation issue that I just talked about, this unexpected burst of inflation. So we're going to have to be really careful about that. Now, we already know that the ports are really clogged. Container ships are few and far between right now, or excuse me, containers. The ports are clogged. Obviously, there's worker issues. I think there's been a really strong demand of goods. There was a note I read this morning that if you want certain types of furniture, you're having to wait 3 to 4 weeks. If this furniture is being manufactured overseas, just because the trade situation is a little bit clogged right now, and that's a function of having more demand than was expected, and so production is struggling to keep up with it. And so if you have an occasion here, which I think we're going to have, with having more stimulus and more money in the economy, you run the risk of having too many dollars chase too fewer goods, and that's kind of a textbook definition of inflation. So we'll have to watch that. So that's enough of that. And let's see, we've just got some comments on just other observation. Let's see. This S&P 500 companies guidance picture. So we had a bunch of companies, I'd say probably for every 20 or so that withdrew their guidance last year, 17 have restored providing guidance to the street, which I think is very positive. We know that they're making more dividend announcements. They're deploying more capital for buybacks. I expect to see more acquisition volume, as a matter of fact. So, that's another thing that I thought was interesting. Mentioned the employment numbers. The 379,000 jobs were added. Interestingly enough, we got a lot of jobs added back in leisure and hospitality. So we see kind of a little bit of positive development here in our weekly short-term indicators, our high frequency data, if you will. And we do see more activity in the hospitality sector. It's coming back ever so slowly. And, if you see more of these states like Texas and Mississippi open, then you're going to have more mobility. I think there's going to be this jailbreak mentality when we're get closer to being fully open, that people are going to want to get out and travel. So that's very interesting to see the jobs being added there. Participation rate continues to go down. It's about 2 full percentage points from a year ago, and that does skew the unemployment rate a little bit when you have less participation in the market. I still do worry a little bit about the long-term dislocation of some of these workers that have been out of the market for the year. It just takes more effort for them to get back in the workforce, and in some cases they're not properly trained and whatnot. We've got, let's see, we've got 1.7 million more part-time workers than we had last year, and for whatever reason. We've got 1.9 million people that are not in the labor force but would like to be working. But essentially, a lot of this dislocation is coming at the lower socioeconomic level. So this just goes back to what I said before about our Fed chair being acutely concerned about these types of numbers in terms of its motivation to want to raise interest rates. So with these kinds of numbers out there, the magnitude of the people that are still, out of work or doing part-time work and want full-time, that until those numbers move down in a meaningful way, I just don't see the Federal Reserve wanting to raise interest rates. On another vein, which, has been our lead for about the last 9 months, has been this virus. The 7-day moving average of daily COVID cases and deaths peaked in the middle part of January, and it's basically down 35 to 40% in February, which is astounding. So we continue to see positive developments on the coronavirus front, and now we're getting the first trickle of data from vaccinations using the J&J, the Johnson & Johnson vaccine, and that will only add to numbers. And there's wide speculation that we'll have enough vaccines to fully inoculate Americans by the end of May, which would be fantastic. And frankly, I think we're apt to have more vaccines and arms to put them in, certainly by the time we get to the end of May, if not perhaps a little bit sooner. We know that maybe 65, approaching 70% of all persons over the age of 65 have been vaccinated, which is a really good number because we were down 10 to 12% not too long ago. So we're making good progress after kind of a clunky start in vaccines. So that's good. Let's see. In fact, across different states, we've had anywhere between 12 and 23% of the population has received at least one shot, and 6 to 14% have received 2 shots. This comes from the latest Fed views which is published by the San Francisco Federal Reserve Bank. And so let's see, that's that. And then let's see, I have one more inflation snippet for you before we kind of conclude today. But let's see. Comments about inflation rising temporarily above 2% because of, on a trailing 12-month basis, when the March and April readings come out, because of some of this producer price input, as well as the impact of food and energy on prices. Let's see, inflation has averaged. These are actually summary notes on this particular topic from Sandy Leeds in his weekly commentary, but inflation has averaged slightly below 2% for over a quarter century. And in 9 years since the Federal Open Market Committee's announcement of a 2% inflation objective, 12-month personal consumption expenditures have averaged under 1.5%. And we've been under 2% in 95 of those 109 months. So, it just goes to show you that the Fed has tried really hard, actually, for a long time to try to generate more inflation, but they haven't been able to. And so, it calls into a little bit of question, just a rhetorical point to end today's commentary on is, how effective is this easy monetary policy, and how more or less effective is fiscal stimulus than monetary stimulus. And, we've printed a lot of money. It hasn't manufactured the inflation that was desired out of this. But, again, looking at last year and some of the motivations behind some of the, current policies in place, we had a pandemic, and it wasn't, printing more money is frankly not going to get your economy back when you're dealing with a pandemic. Frankly, you just got to open the economy. And so I think we'll begin to see some real traction, real numbers. We'll see some really tangible things to kind of hang our hat on once we get more of the states open safely, because getting our economy back to 100% is really going to be the barometer. It's not going to be how much money the Fed pumps into the economy by quantitative easing. It's going to be the ability for consumers to get out and spend, the ability for consumers to have the wherewithal to spend, and the ability for businesses to be able to hire to meet the incremental demand because these economies are opening. So that's what I'm spending my time focusing on. But I tell you what, the environment looks a lot better than it did even 9 months ago. And again, just to reiterate, equity markets are trending in a positive direction. May have a little noise here short term. We've already seen some of this insofar as the rotations, how the rotations have played out. Interest rates are moving up for the right reason. We're seeing a little bit more inflation, but it's only getting us close to kind of a normalized inflation level. So I'm very content with how things are tracking right now. On behalf of the entire team at BKA Wealth, I really appreciate you taking the time to listen to this. I hope you've enjoyed it. Welcome your comments at the contact information you see on your screen. We'd love to hear from you, and during the coming week here, hope you have a safe week, a productive week, and look forward to talking to you again soon. Take care.